The US just announced new tariffs, 10% to 12.5% on goods from dozens of countries. And the timing could not be worse. Europe's economy already contracted in Q1 2026. Germany's main stock index dropped 1.38% in a single week. The pan-European stocks 600 fell for the fourth time in 5 weeks. And now a fresh wave of trade pressure is arriving. This is not just a Europe problem. If you hold any globally diversified fund or ETF, this touches you directly. Let me explain exactly how. This week, the Trump administration confirmed it is moving forward with new tariffs. The range is 10% to 12.5% on a wide basket of imports. The announcement came on a Wednesday. Markets immediately reacted. European investors had been cautiously watching two things. First, the Israel-Iran conflict and what it was doing to oil prices. Second, the fragile progress on a potential ceasefire. Then the tariff announcement landed on top of all of it. Germany's DAX closed down 1.38%. France's CAC 40 managed a tiny gain of 0.43%. Italy's FTSE MIB slipped 0.29%. The UK's FTSE 100 fell 0.40%. On the surface, those numbers look small, but they are not the full story. Because what matters is not just this week's movement. It is the direction these markets were already heading before this news hit. Here is the part that does not make headlines often enough. Europe's economy actually shrank in the first quarter of 2026. That is called a contraction. It means the region was producing less economic output than before. That alone would typically push central banks toward cutting interest rates. Rate cuts usually help stock prices recover. They make borrowing cheaper for businesses. They encourage spending and growth. But tariffs complicate everything. When tariffs arrive, they push prices up. Higher prices look like inflation. And central banks hate raising rates while an economy is contracting, but they also cannot comfortably cut while inflation is creeping back up. This creates a trap. It is called stagflation risk, slow growth combined with rising prices, and it is one of the hardest environments for investors to navigate. Europe stepped into this week carrying that exact risk profile. Now let us slow down and make this real for a moment. If you are an everyday investor in the UK, Europe, or even the US, you probably own some international exposure. Most target date retirement funds include European equities. Most broad global ETFs allocate 15% to 25% toward European stocks. If Europe enters a prolonged tariff-driven slowdown, those allocations feel it. Here is a simple example. Say you have £50,000 invested in a global index fund. A conservative estimate might put £10,000 of that in European equities. A sustained 10% to 15% drawdown in European markets over the next 12 months. That is £1,000 to £1,500 of impact. Not catastrophic, but not invisible either. And that is before accounting for currency effects. A weaker euro means your European holdings buy less when converted back. It adds a second layer of pressure that most casual investors never factor in. But here's where the story gets more layered. Tariffs do not just affect stock markets. They change the cost of actual goods. American manufacturers who rely on European components face higher input costs. Those costs tend to get passed on to consumers. We have already seen grocery prices rise 0.7% in a single month in the US. That was partly driven by higher fuel and transportation costs tied to Middle East tensions. Add tariff pressure on top of that supply chain stress, and inflation that looked like it was calming down starts to look stickier. That matters for the Federal Reserve. Just last week, the stronger-than-expected jobs report already shifted the interest rate conversation. Markets moved from pricing in cuts to wondering about potential hikes. Now, a new tariff cycle adds more upward pressure on prices, which gives the Fed even less room to move. Hold that thought for a moment, because this is where the everyday investor connection becomes very direct. If you are carrying debt right now, this matters to you personally. A mortgage, a car loan, a credit card balance. If the Fed holds rates higher for longer because tariff inflation makes cuts politically difficult, your borrowing costs stay elevated. If you were hoping for a rate cut to refinance your home this year, that timeline just shifted. And if you are a saver sitting in a high-yield savings account enjoying solid interest income, the news is slightly better for you. Higher for longer rates keep those yields attractive, but only as long as inflation does not outpace what your savings account is actually earning. This is the tension most financial headlines completely skip past. If you enjoy breaking down markets and money, subscribe for future updates. Now let us look at what investors should actually be watching from here. The tariff announcement is not the end of the story. It is the beginning of a negotiation cycle. History shows us a pattern. When broad tariffs are announced, two things typically happen. First, markets react negatively in the short term. Second, negotiations begin quietly in the background. We saw this dynamic in 2018 and 2019 during the US-China trade tensions. Initial announcements caused sharp drops. Then exemptions, pauses, and deals softened the blow over months. The question for European markets right now is timing. How long does the uncertainty last? How much damage accumulates while negotiations unfold? Germany is particularly exposed. It is the largest European economy. It is a manufacturing and export-driven country. New tariffs hitting German automakers, industrial goods, and chemicals hit the DAX directly. That 1.38% single-week drop we saw, it could deepen if talks drag on. France, with a more domestically oriented economy and a slight stock gain this week, looks comparatively resilient. But even Paris cannot fully escape a slowdown in its largest trading partner next door. So what does all of this mean practically for someone building wealth right now? A few things worth thinking through. First, do not panic sell European exposure. Short-term tariff volatility rarely justifies long-term portfolio restructuring. Historically, investors who sold on tariff announcements missed the recovery. Second, pay attention to currency trends. A weakening euro against the dollar changes the real returns on your international holdings. It is worth checking what currency hedging your funds use. Third, watch how the Fed responds to tariff-driven inflation pressure. If rate cut expectations continue to fade, cash and short-duration bonds become more attractive as a complement to equity exposure. Fourth, for European investors specifically, domestically focused sectors tend to hold up better in trade war environments. Consumer staples, utilities, and healthcare often outperform export-heavy industries when tariff pressure rises. None of this requires dramatic action today, but it does require attention. The market is telling us something right now. Europe entered this tariff announcement already fragile, and the combination of slow growth, high energy costs, Middle East uncertainty, and fresh trade pressure is a difficult mix to absorb. The people who understand that full picture make better decisions, not because they predict the future perfectly, but because they stop being surprised when it arrives. That is the difference between reacting to markets and understanding them. Next week, this market will look different. Make sure you are watching.